A credit crunch has unfolded in 2023, threatening to collapse American families as lending conditions tighten while the cost of living continues to rise. The battle between Republicans and Democrats over the debt ceiling could send the U.S. economy into recession, and the fear is a much worse recession. Perhaps 7.5 million people would lose their jobs if that happened. Now let's dig deeper to analyze the crisis. Access to credit is a major issue for American consumers. Today, we are more indebted than ever, and the risk of widespread failure of the banking system is much higher. As a result, financial institutions are much more careful about how they lend money. Today, the combination of persistent inflation and rising interest rates is putting further strain on consumer budgets, and data shows that most households are reaching breaking point. For the first time, Americans' credit card debt levels have reached a new but unexpected milestone. They have exceeded $1,000 billion, according to data published by the Federal Reserve Bank of New York. In the second quarter, credit card balances increased $45 billion, or nearly 5%, to $1.03 trillion. That's more than 3 times the average amount of new debt that households have taken on in this period since the Great Recession. The Fed's latest quarterly report on household debt and credit shows this is because the cost of living has increased 4 times faster than income since 2020. For middle-income households and below, about half the population relying on credit has become their only option to pay for basic expenses. Despite a strong job market, a growing economy, and growing consumer spending, persistently high inflation coupled with rising interest rates have weighed on consumers, especially those who are not among the 14 million homeowners who refinanced during the pandemic, thereby hampering their businesses. Super financial investment, low interest rates, and $430 billion earned in the process, an increase of 36% compared to the second quarter of 2022. Even if hardship withdrawals are made by a tiny fraction of all plan holders, this is another sign that cracks may be forming in household finances. There is a lot of data that shows people are doing very well, delinquency rates are low, and unemployment is low, Schultz said. But there is also a limited amount of debt that people can manage before delinquencies really explode. New delinquencies continue to rise from recent historic lows. Rising credit card debt and auto loan balances helped push overall household debt levels up 1% to $17.06 trillion in the quarter, according to the report. Total household debt has increased by $2.9 trillion since the end of 2019, before the pandemic. New York Fed debt balances are nominal and not adjusted for inflation. The increase comes at a time when interest rates are rapidly reaching a 22-year high. Unfortunately, it's only going to go up from here, said Matt Schultz, principal credit analyst at LendingTree. The drivers for this are inflation, rising interest rates, and generally the cost of living in 2023. The company estimates the average household credit card debt is $10,170. The Fed's policy allows credit card companies to charge higher interest rates, making balances even harder to pay off. Currently, credit card interest rates are at a staggering 20.6%. At the same time, it is becoming increasingly difficult for the average person to borrow money or get approved for a credit card, as banks and other financial institutions continue to tighten their lending standards. They flatly reject applicants, raise minimum credit score requirements, charge more interest, and lower credit limits. Last spring, after the collapse of several major banks, some financial analysts sounded the alarm about what was called a credit crunch, a term used to describe the economy when consumers and businesses can no longer access the loans they need. Data from the U.S. Central Bank shows this trend from a different angle. By the end of June, rejection rates for all types of loans, including credit cards, mortgages, and auto loans, had increased to nearly 22%. This is the highest level in 5 years, and one of the highest numbers since the survey began in 2013. The current credit crisis will strangle the finances of many heavily indebted borrowers, Now is the time to prepare for the stressful years ahead. Banks are in danger. The financial system was shaken. The Fed won't bail us out anymore. Therefore, the risk of disaster is very real, and the longer we wait, the worse the problem becomes. According to Bankrate, the average credit card charges a near-record interest rate of 20.53%. According to the analysis of New York Fed data, credit card balances have increased for 5 consecutive quarters, reaching the highest growth rate in 20 years. Early default rates for credit cards, auto loans, and home loans increased during the quarter. While new mortgage delinquency rates remain lower than before the pandemic, auto and credit card delinquency rates are the highest since Q1 2018 and Q1 2012, respectively. U.S. consumers have so far been resilient through the economic challenges of the pandemic and post-pandemic period, the researchers wrote. However, rising balances may pose challenges for some borrowers, and resuming student loan payments this fall may put additional financial pressure on many student borrowers. So, is there any way to step back? Federal student loan payments are expected to resume in October after a more than 3-year pause due to the COVID-19 pandemic and the Biden administration's debt forgiveness efforts. New York Fed researchers told reporters Tuesday that the Biden administration's recent rollout of debt repayment programs should help soften the blow for borrowers. However, not all finances are created equal, and some households may find it more difficult to supplement their monthly payments. This is going to be a very big test for a very large number of Americans, Schultz said. People's budgets are really tight. Once these things start working, we don't know what it will look like. As debt piles up, it will inevitably force people to limit their spending further, said Morning Consult's Baig. Consumers have cut back on spending or turned to savings to cover expenses that don't fit their budget. What we're going to see here is essentially a change in behavior for survival. A credit crunch is when banks won't give you credit and banks no longer lend to each other. Federal Reserve Chairman Jerome Powell said Wednesday that the collapse of Silicon Valley Bank and the banking system upheaval it caused could lead to tighter credit conditions for households and businesses, which in turn will affect economic outcomes. In other words, yes, a credit crunch is coming. Credit crunches are nothing new. They are constant companions during recessions, but not always. They also vary in severity and duration. Key factors, Powell said, are unknown at this time. Some crises, however small and concentrated, can weigh on growth without paralyzing the entire economy. Tighter lending restrictions could hamper the economy for years. So what do you think about this credit crunch crisis? Does it wipe out millions of Americans this winter? Comment your thoughts, and do subscribe and hit the like button for more. See you.